Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Understanding Efficiency Ratios, a guide to analyzing business performance. How well a business uses its resources can make or break its success. That's where efficiency ratios come in. These simple calculations help measure how effectively a company manages its assets, liabilities, and operations. In this video, you'll learn how these ratios work, why they matter, and how to use them to evaluate performance. Understanding them is key to making smarter financial decisions. Let's get started. What are efficiency ratios? Efficiency ratios are key tools in financial analysis. They tell you how well a business uses its assets and liabilities to generate income. These ratios offer insights into whether a company is maximizing productivity and managing its resources effectively. By examining efficiency ratios, you can uncover areas where a company is excelling or may need improvement. They're straightforward but incredibly valuable for anyone serious about understanding financial performance. Importance of efficiency ratios. Why do efficiency ratios matter? They go beyond just numbers, they highlight the health of a company's operations. For example, if a business takes too long to collect payments or convert inventory into cash, it could face cash flow problems. These ratios provide a snapshot of how smoothly things are running day to day. Consider them as diagnostic tools. Just like a doctor examines vital signs to assess health, investors and managers use efficiency ratios to judge a company's operational fitness. They can reveal inefficiencies that, when addressed, could boost profitability significantly. For businesses looking to compete, monitoring these ratios is not optional, it's essential. Types of efficiency ratios. There are several types of efficiency ratios, each focusing on a different aspect of performance. Here are the most common ones. Inventory turnover ratio measures how quickly a company sells and replaces its inventory. Accounts receivable turnover ratio shows how efficiently a company collects payments from customers. Accounts payable turnover ratio indicates how fast a company pays its suppliers. Asset turnover ratio reflects how well a company uses its assets to generate revenue. Working capital turnover ratio evaluates how effectively a business uses its working capital to produce sales. These ratios provide a well-rounded view of operational efficiency. Together, they help pinpoint both strengths and weaknesses in a company's financial performance. Understanding these metrics isn't just for accountants, it's for anyone who wants to make better financial decisions. Key efficiency ratios explained. Efficiency ratios play a crucial role in understanding how effectively a company operates. They shed light on a company's ability to turn resources into revenue, manage obligations, and keep operations running smoothly. Below, we'll break down some of the most important efficiency ratios, their formulas, and why they matter. Asset turnover ratio. The asset turnover ratio measures how efficiently a company uses its assets to generate revenue. It shows whether the business is making the most of its investments in equipment, inventory, or other resources. Formula. Asset turnover ratio equals net sales divided by average total assets. For example, if a business has $1 million in net sales and $500,000 in average assets, the ratio equals 2. This means for every dollar invested in assets, the company generates $2 in revenue. Why is this important? A high ratio indicates efficient use of resources, while a low ratio might signal underutilized assets. Comparing this ratio to competitors within the same industry gives a clearer picture of a company's performance. Inventory turnover ratio. The inventory turnover ratio shows how quickly a company sells and restocks its inventory during a specific period. This metric illustrates sales efficiency and inventory management. Formula. Inventory turnover ratio equals cost of goods sold, COGS, divided by average inventory. For instance, if your COGS is $500,000 and your average inventory is $100,000, the inventory turns over 5 times in that period. Why does this matter? A higher ratio means faster inventory turnover, which is generally a good sign. However, an excessively high ratio could indicate stock shortages, while a low ratio might suggest overstocking or weak sales. Finding the right balance is key to managing costs and meeting customer demand. Accounts receivable turnover ratio. The accounts receivable turnover ratio evaluates how efficiently a business collects payments owed by customers. It provides insight into the company's cash flow and credit policies. Formula: accounts receivable turnover ratio equals net credit sales divided by average accounts receivable. For example, if net credit sales are $200,000 and average accounts receivable is $50,000, the ratio equals 4. This means the company collects its receivables 4 times in the period analyzed. Implications: a high ratio suggests efficient collection efforts and reliable customers. On the other hand, a low ratio may point to slow collections or risky credit practices, which can hurt cash flow and liquidity. Accounts payable turnover ratio. The accounts payable turnover ratio measures how quickly a company pays its suppliers. It reflects the company's ability to meet short-term obligations without delaying payments. Formula: accounts payable turnover ratio equals total purchases divided by average accounts payable. Let's say total purchases are $300,000, and average accounts payable is $75,000. The ratio equals 4, meaning the company pays off its suppliers 4 times during the period. What does this tell you? A high ratio shows prompt payments, which can improve supplier relationships but may signal overly tight cash management. A lower ratio could indicate delayed payments, potentially straining relationships or signaling cash flow challenges. Operating efficiency ratio. The operating efficiency ratio assesses how well a company controls operating costs relative to its revenue. This ratio highlights management's ability to keep expenses in check while driving income. Formula: operating efficiency ratio equals operating expenses divided by net sales. So, if the business has operating expenses of $250,000 and net sales of $1 million, the ratio would be 25%. That means 25% of the company's revenue goes toward covering operating costs. Why is this critical? A lower ratio suggests the company is managing its expenses effectively, leaving more room for profit. A higher ratio may indicate that operating costs are eating into revenue, hurting overall profitability. Each of these ratios provides actionable insights. Taken together, they create a comprehensive picture of how efficiently a business operates, enabling smarter decisions and fostering growth. How to analyze efficiency ratios. Efficiency ratios give you a clear picture of how well a business is operating. But to truly understand their meaning, you need context. Simply glancing at numbers won't cut it. The 2 most common ways to interpret efficiency ratios are through benchmarking against industry standards and tracking trends over time. Both approaches provide valuable insight into a company's performance. Benchmarking against industry standards. Comparing efficiency ratios to industry benchmarks provides a reality check for your business. Industry standards vary widely depending on the sector, so numbers on their own don't tell the full story. For example, an inventory turnover ratio that's excellent in manufacturing might be too low in retail. How do you know where your business stands? By looking outward. Research your industry's average efficiency metrics. Trade associations and financial reports are great places to start. Compare your company's ratios to competitors of a similar size. For example, a mid-sized company won't have the same efficiency ratios as a large corporation. Watch for outliers. Ratios above the benchmark may highlight strengths, but they could also signal risky practices like understocking inventory. On the flip side, ratios below industry averages might reveal inefficiencies slowing you down. Think of benchmarking as a compass. Without it, it's easy to get lost. It gives your ratios context, helping you make meaningful comparisons and see where adjustments may be necessary. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.